Good evening, everyone, and welcome to another ACY Securities webinar. For those of you who might be new tonight, my name is Alistair Schultz, and I'm the Chief Market Analyst at ACY Securities. And I have spent a long time learning and dedicating myself to trading and investing just in general. I've spent nearly 15 years in the market, so I am somewhat of a veteran. And that experience has ranged through a variety of different brokerages and as well investing houses, including working on the floors of Wall Street. So I have done a fair bit. There's not too many different products that I may not understand or not know. I might have a bit of knowledge on pretty much everything these days. So if you do have a question throughout tonight's session pertaining to a particular market that you want to have a look at, feel free to let me know. Just drop a message into the webinar chat function, and I will gladly be of service to give you a bit of a hand with that. Now, if you are watching this through YouTube, then please just leave a comment. Don't use the chat function because I may not actually see it or notice it whilst I'm actually going through the events of tonight. But if you aren't certain how to do it and you are using Zoom to do it, you simply have to go up to the More option, click on Chat, and you'll bring up a little chat box. Alternatively, you can hit the Alt and the H key at the same time, and you will end up getting yourself with a little chat box so you can send me a message directly in. Now, tonight's game plan is to really have a bit of a chat about what's going on the US stimulus side. We'll have a bit of talk about these reflation expectations and how people generally feeling at the moment. I am intending to have a look at oil, both Brent and WTI, because I think it is kind of an important point or milestone where it's at right about now. And then we might even have a little bit of earnings season talk and just a general overview of what's going on. So if you do have a chart, feel free to put them in. We'll get underway just to get things kicked off pretty early on. And of course, any other questions that you may have, feel free to let me know them. Now, to get started, I always have to give a risk disclosure warning, which is what we've got on the screen right now. This statement basically says that trading carries a high level of risk, particularly on leveraged products. Now, if you haven't traded before or you are getting into trade and you're deciding about doing it, it's important to understand what your investment objectives is. You need to be able to say, I'm going to get in with this amount of money and I'm intending to withdraw this amount. And then to bear in mind what your risk tolerances might be with that, because there is always a chance that you can lose the money. So never invest anything that you can't afford to potentially lose. Outside of that, obviously, if you do require some assistance or any of those things do sound like yourself, then please either get in contact with me or seek some financial advice from an independent. And either way, if you get in contact with me, I will try and put you in the right direction with someone who will be able to help you a little bit more. Tonight is really all about generalized advice. I'm not giving any personal information. I don't know your own circumstances, particularly from a financial point of view. So everything is really expressed as my own sort of an opinion. But please feel free to ask away. I'm happy to give my opinion at any time throughout the evening on whatever it may be. And of course, if the question is a little bit in depth or it requires a little bit more research, perhaps on my behalf or on certain things, then I will do my best to answer it on the spot. But if I can't, then please let me know your email address and I'll send one back to you. I'll also provide my email address at the end so that you are welcome to email me directly and I'll try and get back to you as soon as I possibly can. Now, to get things sort of underway, I do have two charts here, like two lots of programs open. I've actually got three different platforms open at the moment just so that I can fit in with what you guys are sort of using. But really, I think the first thing to sort of can start thinking about is what's going on with US stimulus. Now, we've really seen 6 straight sessions of gains, more all-time new highs on most benchmark indexes. The S&P 500 is up there. The NASDAQ is well and truly up as well. We've seen the Dow Jones really sort of smash it away, as well as the Russell 2000. So anything US-based is sort of going up. And I think investors are feeling much, much more confident in their expectations for the economy and getting back on track into recovery mode, as we sort of call it. And it's hard to argue with them. Like, how couldn't you really feel a little bit optimistic about the future? We've got improving corporate earnings. Yields on 10-year treasuries are climbing back up. We're seeing declining coronavirus case numbers, whilst at the same time we're seeing increasing numbers of vaccinations. So, that simultaneous effect is starting to play out. Not to mention, we've obviously got more stimulus that's likely inbound. Both President Joe Biden, I'm so used to saying President Trump, I haven't been able to get my head around that yet. President Joe Biden and Treasury Secretary Janet Yellen are being very, very committed to the idea of a very large fiscal stimulus package. Now, there's obviously still, a need to weigh the side of risk on both sides. It's sort of floating in the air at the moment, and we are getting a lot more speculation about the talk of inflation. So, the inflation picture to me is one that is going to hang around for some time yet to come. It's still obviously very early days. I think right now, globally, in the inflation levels are very, very, very low, and it's not going to stop us sort of dwelling on the idea or even getting involved in discussions that would revolve around the idea of inflation running hot, running away, or even potentially becoming hyperinflation. So, the primary discussion point is repeatedly being seen at the moment about inflation and its concerns that inflation could build much, much too quickly, particularly with a stimulus package nearing $2 trillion. And so much of the stimulus packages that we've seen throughout 2020 so far have, in essence, not only taken over the entire amount that was done in the last decade since the GFC, but have certainly gone above and beyond. So, I don't think, the fears of thinking about inflation running too hot or too quick are actually unjustified. I feel there is probably a little bit of a memory lapse on the behalf of quite a few different economists, particularly those who might be in my own generation, who may not ever have actually experienced really high inflation levels in their adult life. So, in my world, inflation has been consistently low for the duration of my entire adult life, and that gives you probably a minor indicator as to my general age bracket. But seeing numbers sort of close to 0% and not far above it have really become a bit of a normal occurrence. I think the last time I saw anything above sort of 2% as a interest rate anywhere pretty much in the world was some other than perhaps looking at places such as Lebanon or Turkey or any of those sort of countries where we're in emerging markets. But in Western world civilization, I don't think I've seen anything above sort of a 2.5% range since probably about 2010. So, whilst that's going on, that's kind of become a bit of a normal occurrence for many, many, many people, not just economists, but also everyday folks. So we're sort of used to seeing those really low borrowing costs. So when the thought of inflation at 10% sort of enters our little investing mindset, it kind of starts screaming in the back of our heads that inflation is a real problem. The untold truth on that front is that inflation can actually be healthy. It's not until the scenario of inflation running away out of control where the central bank's reactionary sort of efforts have done very little to sort of slow it down, like what we saw sort of in the much before 1990 sort of thing. Now, if that does become a bit of a leading concern, then obviously it enters into a phase of hyperinflation, and that does bring concern. You've kind of got to look at both those scenarios as concerning and potentially a nightmare. Now, depending on the sort of financial circumstances of each individual, of course, both of those things might be something you're interested in or not. But of course, the potential for it to happen does still exist. And once inflation does actually run hot, it's pretty hard to bring it back to reasonable levels in a timely manner. And certainly it's almost impossible to do it without impacting jobs. The idea being that if you've got the maximum fostered accepted level of employment, which they generally sort of accept anywhere between 4.5 and sort of 5.5% as being a healthy level of unemployed, incorporating sort of elderly who may have retired and a bit of everything on that sort of front, and having inflation and keeping that same sort of track. If you've got inflation that's obviously going to foster more employment and might even see the numbers get below that when you're seeing sort of what we've got now. In some instances, it's like 0.6% in the UK and Europe and not much higher anywhere else in the world. Once it starts to run hot, obviously it means that people have to pay more money for goods and services. So therefore, the cost of goods and services go up, the money supply has gone up, and that results in higher numbers of inflation, which eventually will lead to potentially the opposite scenario of what you actually want to happen. And that might mean that you aren't able to afford the extra employee, and you have that happen 100,000 times in different companies, and it does become a very big problem for the general economy overall. But even though that is obviously a point of concern for the future, it's really important to remember that whilst right now, this very second, I feel that the market is kind of in this sweet spot for corporate earnings, for optimism, for growth, for borrowing costs, and quite simply, it just isn't going to last forever. And to put it real easy, the more money supply that you have added to an economy, the more demand for goods and services, which results in that higher inflation figure. So, I'm already sort of turning my attention when it comes to that sort of front to the market's next sort of expectations. And in our world of economics, we might, or in trading, we might think of it as the reflation trade. And the key areas that, I've been focusing on around this is probably more about the idea of corporate dividends. So, if you purchase a stock and you are getting a dividend payment out of that sort of thing, then we need to sort of keep in mind what you're always trading off. Is the corporate dividend worth more than the 10-year treasury yield, or vice versa, the other way around? And you look at that gap, and that gap makes the difference between whether you're going to invest in one or the other. Now, in the market's current snapshot, if you were to basically take a quick snapshot of the entire market as a whole, S&P 500, doesn't matter what it is, you're likely going to find that about 60% of the stocks are effectively more attractive via a dividend payment than what the 10-year treasury yield would offer. So at this point in time, I think the 10-year treasury yield benchmark is about 1.18% on your capital over, obviously that period of time. So if you're then looking at your stocks, you can clearly, even just from dividend payments, make more of that. So I know for a fact in the S&P 500, it's like 59% of all stocks in the S&P 500 offer a much more attractive dividend result than what you would get out of a 10-year treasury benchmark. So if you were to push treasury yields to 1.75% or even get it closer to even 2%, which indicates that inflation is in fact rising, it closes that gap down to about 44% of stocks, providing a more attractive result in terms of a dividend payment. So you might see where I'm already going with this. You keep increasing that number, you push bond yields to 3% or 5% or wherever it may be going to next, in line with where inflation is heading. And all of a sudden, the cost of corporate debt rises so much that the dividend ultimately the attractiveness of the stock itself begins to fall. So the first things that are really going to happen when we do start to see inflation is likely going to be along the lines of stocks with high growth over longer durations are likely going to feel the pressure much earlier on when inflation does start to rise, particularly when you consider the sentiment towards inflation and that whole picture as a big picture starts to grow. So, I think the inflation side of or inflation levering stocks are probably something that should be starting to be looked at least from my own perspective. And I'm certainly doing it. I think in 2021, by the end of this year, we're already sort of expecting to see bond yields starting to rise, aiming somewhere between 1.5 and 1.75%. If not, they may run a little bit hotter. So especially, now that we've got another run of stimulus coming that's going to get loosed into the market, and of course, other countries in the world are doing very, very similar actions, I think it's time to sort of ask yourself, which inflation-based trade is going to be the best ones for you. Now, I'm not going to try and stipulate because, again, it's generalized sort of advice. But from my perspective, the difference between an inflationary trade or a reflationary trade and a cyclical trade are almost the same. They have a very, very similar sort of thought process that goes behind them. So you are likely going to be looking at sort of banking and industrial sectors for some of your clues to get started in looking. Generally, just because they have so much in common on they have a lot of overlap as well. So, mostly, yes, you can look at financial sectors, but more specific to banking sectors, when inflation goes up, borrowing costs goes up, commissions go up, they make more money. The industrial side of things means that with more money supply, government projects tend to start taking a little bit more front foot. So bear that in mind when you are going to look at them. Now, whilst it is all still that we have to think about that, please keep in mind, sweet spot still sitting in it right now. But we do have those expectations for it to come at some stage. Probably not, maybe in the near term, but I'm thinking probably more towards the end of this year, which, depending on how your perspective of time sort of goes, that may in fact end up being a little bit closer. Now, the other one to sort of consider on this front, I'm just going to bring up a bit of a look at WTI oil, and we're going to have a look at Brent as well, just while I'm sort of talking through some of the ideas around what's going on. So to sort of get us off the bat, first things you'll notice is Brent up near $61 per barrel, and WTI is $58 per barrel, having achieved a maximum of $58.58 per barrel in this week so far. Now, realistically, oil prices back up at $60 or very close to it is a really, really good recovery. Though I do have my own concerns about it. Firstly, the fundamentals of what's going on with oil right now, we have some similarities starting to raise questions again from what we saw last year in the oil crash. Now, if you remember, I'm just going to zoom this out so you can have a bit of a look and jog your memory about what's actually happened. So here's our daily chart. This is the oil crash I'm talking about just here. Now, this isn't even the worst of the brunt, because on your CFDs, you will get, we roll to the most forward futures contract at the time. So the futures contract, got rolled forward at around this point as well to the next month ahead, which did save it from, CFDs from turning into negative value. But even then, lowest point, about $3 a barrel, which at that point, the barrel of oil, the barrel itself is worth more than the oil inside that's inside of it. So what we really saw, the worst case scenario on some futures with expiries, basically for that month of the March, April sort of section, we're seeing negative $37, meaning that every barrel of oil, like if I had 10,000 barrels of oil, for every barrel I someone wanted to buy, they wouldn't actually buy it. They'd take the barrel of oil, and then I'd have to give them $37 as well for each single one. So naturally, a lot of people lost out on money on this rundown. Now, just to give a bit of a recap on what's happened here versus what we're sort of seeing now, and just to sort of put a bit more scope into the picture, prices last in sort of 2019 were hovering in the $50 to $65, $66 sort of range on WTI oil. And when we looked at Brent, we were getting sort of similar sort of things going on. We're a little bit higher on the $75 side and between $56. So, you've got about a $5 to $10 price difference between the two. Outside of that, not much difference. And prices are starting to come back to sort of the median average that they spent during 2019. Obviously, we had these big sort of moves happening earlier throughout. We had a bit of a crisis happen in 2017 on supply demand side of things. But a lot of the time when we think about what's going on with oil, we've really focused on the idea of really only supply and demand being the most important elements of it. How many barrels of oil do we have? How many people actually want them? And that's been the main catalyst for quite some time. Now, if we think about what happened in, the fall that we had way back when, that catalyst was really the same thing. We were seeing prices at around the $60 mark, and Russia and Saudi Arabia were having a bit of a disagreement. They effectively, the reasoning behind it is you've got a Saudi Arabia, Russia, and the US relationship that they sort of have a bit of information going back and forth on each one. If you were to look back at what the real scenario was, and I'm just going to give the summary now, effectively when it comes to fracking, so this is more applicable for WTI oil, but it does affect the prices of oil sort of around of all natures. When we look at US oil, the most common element of or means of extracting oil is via using a method called fracking. So if you have ever seen sort of anything related to fracking, you would know already. But essentially, this looks at the idea, and I'm just going to bring up a bit of a picture of what I'm talking about. Fracking is basically trying to break up what happens in the ground between these slates. So this one might be a better one. So in here, we've got shale in this image. I'll just bring it up a bit bigger so we can sort of see it. And so shale, slates, all very similar sort of types of stone. And in between the shale, there are areas and fissures that have oil in them. So the idea is they drill right the way down, they crack through the shale, and then they're able to extract it. In addition to just getting the oil, they also actually get a few other pieces of things like natural gas and other sort of substrates that they might be able to use. But it's not necessarily a very cost-effective process. So it costs the US somewhere in the realm, probably about, like, they don't become profitable until about $60 a barrel. And throughout, since fracking sort of started, probably in the last decade or so, we've seen, anytime oil prices are about $60, the US starts getting their inventory numbers up because it's, cost of business is actually enough for them to warrant doing that. Now, when we look at what's happening last time, Russia doesn't like the idea of what that means for them. Increase of means they lose a little bit of the market share that's available, meaning they don't sell as much oil, they don't make as much money. And Russia is one of those countries that would prefer to have more oil sold than a better price for it, because it means that one of their leading competitors might take some of that market share to some of the countries that they would generally export to. Saudi Arabia, on the other hand, likes to get as much money per barrel as possible because they generally have what you consider to be a low-grade crude quality. It's kind of a mixed bag. And they do dictate where things sort of go. And so, this whole scenario has sort of been well known. It's been made well known to sort of happen. And so that's generally what happened. The only downside that we saw back in March last year was that we had a pandemic sort of kicking off. So I think that was, probably lack of foresight on the oil baron sort of idea of things. And when they all didn't agree, Saudi Arabia went, okay, well, if you're not going to abide by what we want, because Saudi Arabia can produce the cheapest barrel of oil at about $8 a barrel, and Russia is about somewhere in the $20 range, they said, well, we'll just flood the market so that you can't sell oil either. And it's not worth you doing it, and we'll just take the entire market for ourselves. And so they did that, and then Russia went, okay, well, we'll just keep flooding the market too at a cost to ourselves, and we don't care until you agree to not do what we want you to do. And so they kept doing that. And eventually this was the result. Now, right now, at $60 a barrel, that relationship still hasn't seen any kind of recovery from that US side of things. And that definitely puts, a bit of pressure on the whole OPEC relationship in general. So we've obviously seen the last time it didn't end all that well. We've got EIA inventories that are due this week at the next OPEC meeting is really going to be the big thing that's on my mind. So even though that's the case, it's not the only end of the world. Now, there is something else that I thought might be worth having a look at when it comes to oil-based commodities. I'm just going to pull up a chart for us to have a look at on one of my other ones. When we think about oil and what might be going on just sort of in general, we tend to find that oil funds and oil stocks for the last sort of 6 years have really lagged on the whole board compared to what the S&P 500 may have done. In fact, so much so that in this year's run of sort of stocks and where we've seen prices moving, they're about 50% behind. So from a certain perspective, I'm just going to bring up Exxon Mobil because that's one that I'm kind of familiar with. But Exxon Mobil, BP, Occidental Petroleum Corporation are all ones that are likely going to give a little bit of an impact on what happens. So considering that, this might not be a bad place to sort of think about where opportunities might lie. Now, Exxon Mobil is one of those companies that has been sort of lagging behind on what's happening. I'm just trying to make it so that you guys can sort of see the full thing, but it's not really playing ball for me. So you'll have to sort of just accept that this is a year of price fluctuation. So, we can see that they've not been able to sort of attain the high that they saw in 2020. If you go back even, we'll put it over 5 years and have a bit of another look, they really suffered when we had this hit in 2020, and they've not been able to recover. If you think about every other market that we've actually had in the S&P 500, they've all ended up shooting up well and truly beyond, perhaps, most of them being tech-based, but those oil stocks have been pretty unloved, and they've sort of lagged behind. And that's been because we've seen oil pricing so low that it doesn't really give a nice place or even thought. Like, you sort of go, well, how can oil really make its next sort of moves on the way up? And whilst that might be the case, now that we've got oil back at $60, and there is concern about what might be happening from the oil front in terms of valuation and price, I personally feel that we're probably going to be quite lucky on the front when it comes to actual oil stocks instead. So I am going to be looking at Exxon Mobil and BP and all those sort of refineries and manufacturers who would likely see benefit of a $60 per barrel oil. And that's not a bad way of sort of thinking. I don't think it's something that I've been keeping my tabs on. And it is one of those ways to sort of go, there's still a way to go yet to sort of establish where it's going to go, but I am getting started with it now. When we think about where we might be looking with oil pricing in general, I think the stability range is between the 60 and sort of the $45 range for WTI. On Brent, I'm thinking that it's probably between the $50 and $60 mark, perhaps $65 mark, because it can afford to go a little bit higher on Brent than what you would in WTI, just because of the location where it's extracted from and where it's shipped to, different shipping lanes and partners, all that sort of thing, makes a bit of a difference. So that is really my general thoughts on that side of things. Now, outside of all of this stuff that we've already gone through, that I'm planning on going to be talking about, or that I have spoken about for earnings season, some of you might be aware of the earnings season going on currently now. Last week, we heard from some of the banking entities and some of the sort of social media companies, plus we heard from Apple, and Apple had a fantastic week. For a company like Apple, it just honestly amazes me that they can consistently just keep building. Oh, what? That's not cool. It only shows me Netflix, but I'll do it on my other one. That's a little bit easier. I think the big thing that sort of surprises me the most about Apple is just that it has constantly got, these fantastic runs. That usually when you see a company getting as big as what Apple is, you expect them to not exactly be able to just continue the growth that they have. But their last quarter, they did something mental, like somewhere in the 100, where is it? Here is revenue, gross profit. Like, they're doing massive numbers, like in the billions on a regular basis, and have been doing so for a number of years ongoing. Like, it's just insane on how much they can just continually churn over. And when a company of this magnitude, like, don't forget, they are effectively a $2 trillion company. Generally, the bigger the company gets, the less likely it is for growth expectations to continue on the same thing. But they're still getting double-digit growth, like, consistently. Whilst I've never been a Mac user, I've used iPhones before occasionally, and I'm not a big person on the Mac side of things in terms of usage. Just their business model is just unbelievably good when it comes to being able to churn over those profits. And I know after previous guy to Tim Cook, Steve Jobs, after he passed away, there was concern that Tim Cook wasn't going to do as good a job, but he has somehow managed to just continue to roll out very, very hard with all that sort of side of things. So, that's general thoughts so far. Now, I might do some marking up since we've been talking a bit about oil, and I've already sort of drawn a line that I like the look of. I might add a little bit to it and keep on going. Now, realistically, this is a daily chart. I do tend to trade oil on more of a daily time frame, but I will quite often snip down to a 1 hour. On the 1 hour, it does make it a little bit unattractive to me because we are so far away from this bottom or the support line that we've kind of gone in, and we can easily sort of draw extra ones as we're going along, which on a 4-hour chart might be a little bit more applicable. But in my eyes, I'm sort of looking at something like this. We've got a bit of a range going on in between here. Probably that one is my favorite sort of fitting, where we've had two breakouts on the top, pop back in, and even if we wanted, you could sort of put one in the middle here and sort of give yourself a double sort of a range that goes on in between. This is one range where price sort of gets stuck and hangs around, which you can see it's happened here, it's respected that line there, and all of these lines are identical, just in slightly different placement, with your extreme side down here. So if we're going to go from just a technical perspective, and we're not going to pay too much attention to the fundamental side of what might happen next, because I believe the moment that we do, for more than one reason, they're either going to want to try and increase supplies, which we already know is starting to happen. The next OPEC meeting is to discuss an increase in output, which we may find they try and keep the price balanced around where it is now. The other alternative is that effectively oil goes a little bit further up in price. The US kicks off production, and we see an increase in supply coming out again, which means prices will still stabilize at about the same point. But it's a matter of what that price point is that they really want to start using. From here on is going to be a little bit, playing around in this sort of range on the top, particularly for WTI. In the immediate moment, there's not really any patterns that sort of stand out to me in price that says, yes, I want to take that. This one here, I suppose you could call it a bit of a reversal pattern, but it's wonky. It's not perfect. It's not exactly appealing. It's very small sort of range price action. I would like to see something a little bit more inspiring, I suppose, before sort of locking into a position. And of course, I'm probably really going to be waiting for the EIA report just to see how supply inventories are going this week. And then from there, I really want to see what we're hearing from Saudi Arabia, Russia, and America. If I see a single report that says fracking is starting back up, then I'm going to expect OPEC to, or some kind of a meeting to occur with Saudi Arabia and Russia at some point. On the Brent side of things, monthly charts, if you want to have, I don't mind looking at it. I don't trade Brent a lot. From here on, monthly charts, technical wise, one at the top, one at the bottom down here. And like the rest of it, price kind of just bounces and range bounces in between here. So the monthly chart on Brent for me isn't super useful. All it's telling me at this point is we're kind of in the middle of everything, and that's not like an awesome place to really, really be, because it makes it very easy for directions to go either way. It's not super solid. But when we do drop down our timeframes, we get almost the same action that's happening in price. So if you look at WTI, and we zoom this, I'll just move this out a bit and put it back on our daily. You've got that sort of run occurring there, same sort of thing happening here. If I zoom that out a little bit, they're not too different, are they? They're almost identical sort of shape. So what you do on WTI, you can usually account to do on Brent, UK Brent as well. Which means it's not a bad opportunity. It can mean double the profit, but it can also mean double the losses. Just depending on what direction you were at the time. But regardless, I do still firmly like the idea of sitting on oil. I think the only other element of oil that is a little bit concerning to me when it comes to sort of the price increases at the moment is the world is kind of pushing away from oil. President Joe Biden's new plans are really pushing towards the idea of ESG investing and renewable energy and all that side of things. So that doesn't sit perfectly with fundamentals, but to a degree, like the world's addiction to oil is going to be around for some time to come. Particularly here in Australia, we don't really have the setup or the infrastructure for electric vehicles. We couldn't drive from one state to the top of the other without needing to charge up, which in some instances you might find yourself not getting near a petrol station for several hundred kilometers, and then to find that you get to that petrol station and there isn't any charging bay for your car. So that does present a problem for us. So I don't notice it, but there are some countries across the world that have rolled out, and you've got nearly 50% of all road-going vehicles based off electricity. So, we have to bear that in mind, that just what we see on perspective on our ground or in our world may not represent what's actually going on in the broader thing, and that's why data is so important. Now, thinking about where we're sitting here in this price, you can't put the same sort of trend sort of following. I mean, you could probably put one down the middle here if you wanted. On this side, yeah, just like that. But this one doesn't fit as perfect. And whilst the moves in WTI and in Brent are similar, they're not identical. So it doesn't always fit the narrative perfectly. Realistically, the play on both of these for me is going to be looking for, long from, if I'm in the middle, then I'm going to wait until I know I've got a breakout in depending on which direction it is. Once I've got my breakout, long from the bottom, exit at the top, vice versa, short from the top, down back to the bottom. And if it busts through again, short from the bottom, from the top down to the bottom, and just keep doing the same pattern. This middle line gives us a bit of a midway point. If we see price get up to there, we can close our positions or hold on to the original ones, especially if you're on this low side, and just rock it up. So that's kind of the plan that I've got formulated at the moment for oil. Naturally, my caveats are always going to be on what's OPEC doing, what's the IEA inventory, are we seeing any more oil getting produced by the US, has fracking restarted? So they're sort of the three key elements that sit behind the scenes of the technical side of things. Otherwise, I would probably be a little bit bullish on oil for the rest of the fundamentals, other than the Joe Biden stuff, which still hasn't come into effect. So until any of those changes happen, I'm going to be sitting in the same sort of direction. Looking at the S&P 500, whenever there's a new all-time high, whether that be the NASDAQ, the S&P, anything like that, I get sketchy. I can't help it. I think it's just behavioral bias. When you do look at prices at the highest levels I've ever seen, you kind of always have this thing about gravity. What goes up must come down. So I don't like the idea of trying to invest at the absolute top of prices, but at the same time, how do you know where the absolute top is? So until the trend is really broken, and we get an obvious area that we are going to be wanting to exit, I'm going to keep on doing the same narrative I've been doing for the last year, which is, again, we've got lots of optimism coming from stimulus. We have people really starting to look positively towards what's happening with vaccines. We've got declining virus numbers, really cheap borrowing costs. And at this point in time, we're just starting to see 10-year Treasury yields rise. So until we actually get towards the end of the year, where we may see inflation levels starting to come up, and coincidentally, the bond yields starting to tick up, and all that side of things, then I'm going to be sticking with that long sort of tech side of formality. Obviously, not every tech company is a good company, but obviously things like Netflix, Apple, your Amazon, and anything along the sort of the big ones, they're going to just keep on chugging away, I think, for the time being. Outside of that, really looking towards those cyclicals or the reflationary trades, banking sectors, industrial sectors, Dow Jones sort of thing. So looking at the DJ, same sort of deal, where we've seen pretty good recovery. In fact, it's beat its expectations. You can easily put a couple of trend lines up on here to give you a bit of guidance if you are looking for them. They are very similar in sort of the approaches. Naturally, there's more than one that fits on this sort of narrative. You can fit with one there, that don't do too badly. The further obviously down you come, maybe the higher the push really seems to be at the moment. So I am still sitting on that bias. You can also sort of rock a bit of one out this way, but it's not exactly a perfect fit anywhere. The one that I sort of look at occasionally is one that sort of runs up this way, but generally I won't draw a line from the top unless I can actually copy it from the bottom up to give myself the range, and that's just kind of a rule of thumb. You always draw your upgoing trends from the bottom, trends on the way down from the top. So considering this has been going up, drawing your own trend line at the top is not a nice place to sort of do it. Of course, if you haven't used Fibonacci retracements, another one that you might be interested in doing is actually running this sort of a pattern going on like that. And we've, sort of pumped our way through all of them. Our 61.8, our 31.2 are really the two big markers that we always try and pay attention to. And the 100% has kept going. So, really, where do you go from there? I mean, your alternatives are you can actually set up more numbers on here and try and get the 161, 261 going on, but I have them on at the moment, and they are a fair way away. So, dealing with a retracement sort of thing like that over a long term is not being all that helpful at the moment for those of you who might use that sort of thing. So that's kind of the gist of things. If you do have any questions, I'd love to hear them. So if you would like to put them in, either if you're on YouTube watching, then please feel free to put them in the comments, and I'll sort of get back to them sort of tomorrow. But if you are in Zoom, then please feel free to chuck up a chart. I'm going to start wrapping it up because I have been now monologuing for nearly 41 minutes. I do hope that everyone has gotten everything that they've been looking for tonight. Of course, if there's anything that you feel I can improve on these sort of webinars, then and live sort of sessions, then let me know. And feel free to either do it in a chat or perhaps even just send me an email, which I will give you momentarily. And we can sort of work it out from there, and I'll hopefully improve things for next time. Now, outside of that, of course, I did promise I would give my email to sort of give you guys a bit of a few thoughts on what is happening. So I will give that to you now. I do have a variety of other social media options available. I have Twitter, I have Instagram. I'm pretty much everywhere, I think, most of these days. I don't think I've got TikTok, but that's one of the only ones. But feel free to sort of check them out on any of my other YouTube videos from the ACY channel. You'll be able to pick that up quite quickly. Now, if you do have questions, perhaps you've got a long-standing question, or you've got something that needs a little bit more detail, then please get in touch with me. Talk to al@acy.com, and I'll happily respond to your emails. Otherwise, I hope you have a great evening. And this week, we're not going to be having a webinar on Thursday. We've got a few other things going on in the office, and it's made it a little bit impractical, but I'll be back, rest assured, next Tuesday, same time, 7 p.m. And I will be happy to go through the charts again with you then. Okay, well, I'll leave it all with you and in your well-rested hands, and I will see you on Tuesday. Bye for now.